Hi everyone. Do you ever find yourself having no idea what your professor is talking about when he tries to explain expansionary monetary policy? Is it basically going in one ear and out the other? If that's the case, then this video is for you. Today, I'm going to explain expansionary monetary policy in two ways: the actual economics definition and then the for dummies version. So without further ado, let's do some background information. Expansionary monetary policy is when the Federal Reserve increases the money supply and lowers interest rates to help stimulate the economy during recessions or slow economic growth. For dummies, expansionary monetary policy is the Fed basically trying to wake the economy back up and get people spending money again. An example from the real world is during COVID, the Federal Reserve lowered interest rates and bought bonds to help businesses and consumers keep spending money. So, what even is monetary policy? Monetary policy is the Federal Reserve controlling money supply and interest rates to influence inflation, unemployment, and economic growth. Expansionary monetary policy helps boost the economy, while contradictionary policy slows inflation down. The for dummies version is the Fed is basically the economy's thermostat. If the economy gets too cold, they turn up the heat. If inflation gets too hot, they cool it down. An example from the real world would be when inflation got high in 2022, the Fed raised interest rates to help slow down spending. How does expansionary policy even work? Well, the Federal Reserve buys government bonds, which increases bank reserves and increases the money supply. As money supply rises, interest rates fall. Lower interest rates encourage businesses and consumers to borrow and spend more money. What that means for dummies is that the Fed makes borrowing cheaper, so people start buying houses, cars, and investing in businesses again. A real-world example would be mortgage rates became very low during COVID, which encouraged many people to buy homes or refinance loans. Let's talk about the main economic chain. The main chain we learned is when money supply goes up, interest rates go down, investments go up, and aggregate demand also goes up. This means lower interest rates increase spending and investment, which helps economic growth. The for dummies version is cheap loans make people feel more comfortable spending money, which helps wake the economy back up. Now, for a real world example, businesses are more likely to expand and hire workers when borrowing money becomes cheaper. So, let's talk about the advantages and risks of expansionary monetary policy. Basically, it can reduce unemployment and help economic growth, but it also can create inflation if too much money enters the economy. What that means for dummies is that it can save the economy during bad times, but if the Fed overdoes it, prices can become ridiculously expensive. An example from the real world would be many economists believe that aggressive stimulus during COVID helped the economy recover quickly, but also contributed to later inflation. So, overall, expansionary monetary policy is one of the Federal Reserve's main tools for helping the economy during recessions. It increases spending and investment in the short run, but it must be used carefully to avoid inflation. What that means for dummies is that overall, the Fed is basically trying to help the economy without accidentally making everything cost way too much. Thank you everyone for watching my Economics 1015 extra credit presentation, and for all the dummies out there, I hope this helps for whatever you need it. Thank you.